Real estate companies have been under the scanner for all sorts of reasons. Delays in execution and mounting debt to loss of credibility. Questions have often been raised about whether the sector's accounting practices provide a true picture of its financial status. A recent guidance note by the Institute of Chartered Accountants seeks to bring more transparency and standardization. But is it enough? Here's a story by Mayura Mantri.
The real estate sector has long been accused of dubious financial reporting practices that don't easily reveal the true story of a company's financial health. And different accounting standards followed by different companies have made it all the more difficult to correctly assess where one company stands vis-a-vis another.
There were some companies that used completed contract method. There were some companies that used percentage of completion method. And even those that used percentage of completion method, they actually applied the percentage of completion method differently. And therefore, to bring in consistency, there was a need to bring in a guidance note.
The recent guidance note issued by the Institute of Chartered Accountants of India states that revenue recognition can begin only once all critical regulatory approvals are in place and the project is at least 25% complete in terms of projected costs, which cannot include cost of land. Also, 25% of a project's inventory should be sold. So far, companies like DLF and Unitech recognized revenues early, and others such as HDIL were more conservative. While the guidance note will help investors, analysts and banks, auditors believe it may make companies' earnings seem lumpy, with little revenue recognition in the initial phase of a project and more towards the end. The note is a step in the right direction, but market watchers say the need of the hour is more aggressive reporting by analysts and researchers, such as a recent report by Veritas Investment Research, which raised questions about DLF's accounting practices.
I don't think this accounting system is going to really be a catalyst to bring about transparency. It is more between the assessing officer and the assessee where it will bring about more clarity. So you'll have less litigation if you follow a particular standardized method. But as far as transparency from an investor standpoint, I think these gray areas can still continue.
For now, there is no denying that the new accounting norms may at least bring in more confidence and interest from stakeholders and, if adopted correctly, help redeem an industry struggling for an image makeover. Mayura Mantri, NDTV.
Vineet Relia, CEO of Sare Homes, and Shrenik B. Bed, Executive Director PwC India, join me to get to the bottom of how much transparency will the new accounting guidelines really drive. Gentlemen, thanks very much for being here. Vineet, I'm going to start with you. I mean, on the paper, it looks fantastic. At least 25% of the project has to be sold before you start booking revenues on it. Would you say that?
Yeah,
it's
that's
a good step?
I think it's a very good step, and our company has been initiator of this. We've been part of the study group with the Institute of Chartered Accountants. And you see, the background is that people like us who are FDI driven, we do the IFRS reporting for the investor, and we do IGAAP for the Indian laws.
Right.
So basically, there's always been uncertainty about the way the revenue has been recorded, and
it was a free-for-all market before this, Vineet. I mean, every developer did a different thing.
I won't say it's a free-for-all. There is no norm, so obviously, everybody has their own perception, I would like to say. I won't say it's a free-for-all.
Okay.
But yes, at least what one can say is now there is a uniform standard which everybody needs to follow. So you can actually have a benchmarking of companies, how they are performing. Another big step is the addition of approvals in this. Now, if you don't have an environment approval and you've not spent the construction, you cannot record a revenue, even if you have the sales and you've collected the money.
Right. So that is very critical
That is a
from
very,
a
very big
consumer's
step
point
from
of
a
view. That
consumer
an approval
perspective.
and construction has to start before any developer, any size, however big he is, starts booking revenues.
The only thing is it puts the company into a lot of pressure in case the state machinery decides not to give approval for a year. You could actually have a project or a particular state where your revenues will completely be vanished.
Completely be dried up, and of course, it's a big question that a lot of money goes into acquiring lands. Mr. Bed, I'm going to ask you this question. Unlike accounting standards, a guidance note is not binding on a company. So what happens from here on? Do you expect large companies like DLF, Unitech, who have been far from these current guidelines, to actually follow them?
See, time will tell whether the companies would follow or not. You're right in saying guidance note is not mandatory, and the auditor has a choice. If the guidance note is not followed, then in that case you will have to qualify the accounts. some of these practices were in place. A lot of things are there in terms of the accounting standards, but some being followed, some need not be followed. So time will tell how things come up.
Okay. What's your sense, Sameer? I mean, one thing is that if a guideline comes which is in line with international practices, people want the money, they want investors, it's better to actually follow them, isn't it?
I think it's one of the best things that could happen for the industry from a consumer point of view, from banks to equity research firms. Proper benchmark will get established, there'll be uniformity, there'll be consistency. I think if there are successful projects where revenues get generated before, and we all know that projects get sold out in pre-launch stages only, then those cash flows are utilized to buy new land banks. That will all stop,
Yes,
because
the
you have
money
to
gets...
now utilize the funds to actually complete the project before you can recognize revenue. Developers used to window dress balance sheets before going out there and raising capital. So they had the whole system in control. Whenever they wanted to show less profits, they would just acquire one land bank and show that as an expense. And if they wanted to show higher revenues, they would just recognize those revenues irrespective of construction.
Right.
So I think government will also benefit, because they'll be able to get consistent taxes from the developers.
Okay, so I'm going to come back to you, Vineet, and ask you this question. I mean, if you look at our current investment climate, every listed company is under pressure to show quarter-on-quarter performance, but this is going to make it extremely lumpy. So one is the markets, how they will recognize this lumpiness, maybe they will come around to it. The other thing is what Sameer just said, will it actually give confidence to PE investors to invest better? Would they feel good about these guidelines being followed by?
I think definitely, because most of the investors, we interact with them day in, day out, and most of the investors say that the revenue recognition is post transfer of risk and award. So basically, which means in Indian parlance is that when you have registered and transferred and handed over the house, that's when the revenue should be recorded.
Right.
Now, going in the Indian scenario, probably they'll you won't have revenue for maybe 3 years, 5 years, because the construction cycles are so long, the approval cycles are long. So I think this is a great step in the right direction, that where the everything is in order now. Approvals are there, land obviously is here, the construction has started, you spend a decent amount on it already.
25% before you recognize
absolutely.
the revenue.
And so until unless something really drastic goes wrong, it's going to come up in time.
Okay, Mr. Vaid, what I need to understand from you is, how will auditors actually assess completion of a project of 25%? So you will have to engage with architects. Do you think it's an easy enough job to be done, or does it complicate your life a little bit more?
No, definitely nothing is easier. When you have a transition, it's going to be, it will stabilize over a period of time. So it is going to put pressure on the finance team of the company, where they will have to work with the ops team to make sure they get all the whatever completion certificates has taken place, they get it to the auditors. Auditors will have to bring in experts who understand the laws, they understand the geography, what all approval processes are required, so that the experts can give comfort to the audit team. So it's going to be crucial. In addition, when we look at the 25% saleable criteria which has been brought in, a lot of properties gets booked early in terms of pre-launch, where you get only the booking amount, or allotment letters are issued before an MOU is signed. You'll have to see necessarily whether that is legally tenable to say yes, it is contractually a contractual agreement. If an MOU has not been signed, and if investor has just invested money, and that's not really sell to the ultimate owner, whether that will be considered while determining the 25% sale which has taken place before recognizing revenue.
Okay, so some of this will just even out over time, but there are certain other practices which still haven't been taken into consideration in these guidelines, even simple things like over-invoicing, Vineet. Is it enough transparency, or do you just think it's the first step?
See, I think regarding invoicing, the note clearly says that you can't even book, like I've given an advance for elevators, you can't book that. The builder has to certify it is installed. Now it's the duty of the auditing firms who are auditing to check.
All right.
So I think this is a great step, and if it is followed, I think we've really come along a long way.
Long way in transparency,
Absolutely.
in accounting norms for real estate companies. Vineet Relia, Vineet Vaid, Thanks very much, gentlemen, for getting to this bottom of it. And seems like the new accounting norms, guidelines they are actually, if they are followed by large developers, small developers, will make your life as a consumer also so much easier, because those developers can't book revenues till they've actually built 25%, sold 25% and started construction after getting all the approvals. Okay, we're going to move back to doing what we do every day on the show. That's taking your questions and helping you take the right decisions with your big money purchase. That's property. This is an email by Anil Seth, who wrote in saying that he wants to sell his property in Horse Cast